Okay, good morning. So today I want us to look at the pension. I want us to look at the accounting for retirement benefits or pension. Now, these are basically the post-retirement benefits that you are going to get when you retire, and especially if you're employed by an employer who normally pays pension or has this pension arrangement. So pension accounting is normally guided by Accounting Standard 19, which prescribes the accounting and the disclosure requirement for employee benefit. And it ensures that an entity recognizes one, liability when an employee has provided service in exchange for benefits to be paid in the future, an expense when the benefit is consumed. So this is to say, when you are employed by an employer who normally pays pension, remember, this is an arrangement where you as an employee contribute a certain amount and the employer also contributes a certain amount. So ideally what normally happens is that when you provide the service, the employer has a liability in the balance sheet, that is accrued pension. But now when he limits that money to the pension fund, like the Zamara pension fund, the Britam pension fund, ICRM pension fund or the mutual pension fund, then it becomes an expense to the employer. So now let us look at the pension fund schemes. So these are arrangements set up by employer, employee, or jointly to provide income to employee after the retirement. So this is scheme, like the way I'm talking about the Zamara pension fund. So the employer and the employee, they remit the money to a certain umbrella. So these umbrellas are the scheme. So and once they remit this money, the scheme reinvests this money and will avail it to the employee once on retirement. It involves regular contribution during employment, which are invested to accumulate funds that are used to pay the retirement benefit. So the moment you contribute that 1,000 shillings to the pension fund, the pension fund normally invests this money in treasury bills, treasury bonds, and treasury uh, or other investment avenue, and this money normally earns interest. So the 1,000 today will not be 1,000 in the in the coming month, and the amount will be compounded and you'll be paid upon the retirement. And of course, we look at when you retire the various mode in which you can get your money. It is a form of post-employment benefit governed by laws, by labor laws, trust laws, and accounting standard. So we have said that the accounting standard here is IAS 19. And the objective of this pension fund are, number one, it is to provide financial security and regular income during the retirement. So when you retire, you need some money to keep you going, to encourage long-term saving among employees. You understand how the economy sometimes is too tough and people do not want to save. Actually, you are saving because you are all over with the Fuliza and all that, to reward and retain employee by offering post-retirement benefit. So most employers who normally offers this post-retirement benefit, they attract and retain employee because everyone want to be guaranteed that his future is safe. To reduce the burden on the state for the old age welfare. So the government want as much as possible to ensure when you are young, you contribute to these funds, like the way we have NSSF, and the government is enhancing it so that when you retire, you not be stressed the government. Right now, I think the government is offering 2,000 shillings per head if you have reached maybe the age of 70, but that's so little. To promote social and economic stability through planned retirement funding. Then we have three types of the pension fund scheme. The first one is called defined contribution scheme. So as the word refer, you contribute a certain amount of money, which is fixed. Let's say 5%, 10%. Then we have the defined benefit. So the benefit, again, this is a predetermined benefit. It's the opposite of contribution. This is now what you're going to receive. And again, it is based on a certain formula. Then we have the hybrid, which is a mix of the two. So now, preparation of the pension fund statement. So there are two main statements which are being prepared for the funds. So the first one is called statement of net asset available for the benefit. This is similar to the balance sheet. The other one is called statement of changes in net asset available for benefit, and this is income and expenditure statement, or similar to the statement of comprehensive income. So this is a format. Now, these are the format of the statement of net asset available for benefit. It has two sides. So there's the asset and the liabilities. So for the assets, we have the investment. So these are the investment. The fund, let's say Zamara, has invested into government security. Yeah, so they have taken out the money that the employers, employers or people who are called sponsors. Sponsors are the employers, those people who made the fund. So they have taken those funds and invested into the government security, government or quoted equities, corporate bonds, fixed deposit. So they have invested this money to earn income. So that is the total amount there. It's called asset of the fund. Then current asset. These are, for example, contribution receivable. The sponsor or the employer has not remitted the money. For example, we normally hear most of the public universities, they don't remit the pension of employee to the pension funds. Then we have interest and dividend receivables. So all this, maybe some amount has not been received, cash and bank balances. So the total asset is that. Then we have the liabilities. So payables and accrued expenses, benefit payables, net asset available for the benefit. So this amount is one which is available for the members. So in the event the pension fund is liquidated, this is what is going to be paid to the or distributed to the respective members. Then let us look at the statement of changes in the net asset available for the benefit. So the change is now the difference. Actually, what we are looking at it from this angle, it is actually this one here, this 106, and we are going to see how. So the format for this one, we have the income. We start with the income, contribution from employers, contribution from employees, interest income. We have interest on deposits, dividends, total income. Then we have the expenditure side, benefit paid, administrative expenses, total fund, net increase in the net asset. So this is the difference between the income, this total income, and the total expense. This is the net increase in asset. It is similar to the profit, the gross profit or loss from the other perspective or the normal accounting perspective. Then we have net asset is January 1st, 2024. So this is the opening balance. This one you can see. This is the opening balance, the fund balance from the previous period. Then if you add these two, yeah, you are going to get net asset as 31st December 2024. That is the end figure. So if you look at this figure here, it should agree with the figure that you have seen here, because that is what is available to the members. So as I indicated earlier, this is a very simple topic and a very straightforward topic. So I would like us to test our understanding by looking at this question. So this will be an assignment, and I would want us to do it and submit by Wednesday next week. So the following trial balance was extracted from the books of Kijani Pension Fund as at 31st December 2024. So this is a trial balance. So one thing you need to know when you are studying the trial balance has two sides. It has the debits and the credits. So the debits, we normally say increase in asset, you debit. So the debit has the asset. Increase in the expenses, you debit. So the debit has also some expenses. Let's go to the credit. Increase in liability, you credit. So you'll find some credits here. Increase in income, they are generally on the credit side. So let us now try to digress. Government security is an asset, as I have even indicated on the format. Quoted equities, asset, corporate bond asset, unit trust asset, cash and bank asset, contribution receivable current asset, interest income receivable current asset. Benefit payable, benefit payable, this is a liability. Accrued administrative expense, liability. Audit fee, liability. Contribution employer contribution asset, income, employee contribution income, interest income, dividend income, net gain, that's an income, benefit paid expense, admin expense, fund management fee expense, custody and transaction cost expense, utilities expense. Then we have the opening balance. So in this one, you can be able to prepare the net asset and the change, yeah, by just classifying those items. So, and the question here is that you are required to prepare the statement of net asset available for benefit and statement of changes in the net asset. So try that question, test your understanding, and submit it by Wednesday next week. Thank you all and have a blessed day ahead.